G'day guys, Seeney here, and welcome to another episode on the Australian Wealth channel. And in this video, we are going to be talking about something that the Australian housing market just did. So thank you guys so much for watching. Please make sure you like and subscribe to this channel. It really helps to get these videos out to more people. So without further ado, we're going to have a look at something pretty crazy and interesting that the Australian property market just did. So as some of you might know, we get data every single month about what the housing market is doing from CoreLogic. You know, they seem to have the best available data based on home sales and the price movement and things like that. So something very interesting to note is that even with all of these lockdowns happening all over the country, it's still boom time for Australian property. The prices are still going up very dramatically. So I have some data from the last month. Of course, we get the data from the last month. We can't get the data right now because it hasn't all been collected. So I have some data from July. And what we've seen is that nationally, around all of Australia, home values have actually gone up 1.6% this month alone, which is just a crazy number. The market is incredibly hot now. There's a lot of people trying to get in. There's so much demand. There's not much supply. And of course, with the construction shutdown that's happened here in Sydney, that's only going to exacerbate that problem even further. So it's something really interesting to note. So if you extrapolate that out, if we were having this growth every single month for an entire year, we're looking at about 19% growth, which is insane. You know, housing prices going up like 20% in a year. Like, you'd be lucky to get that return in stocks, let alone real estate. But that is what we're seeing. So, however, there is something very interesting that I wanted to point out for people right now. So while the market is still really hot, we're going to be narrowing in on the capital cities so we can kind of segment that data a little bit more and explain what's going on. So in Sydney, we've spent all of July in lockdown, but yet the property market still remains really, really strong. In fact, we've actually seen a 2% gain in Sydney this month alone while everyone's been in lockdown, which is crazy, absolutely crazy figures. In Melbourne, we've seen a 1.3% gain. In Brisbane, we've actually seen a 2.2% gain. And in Canberra, we've seen a 3% gain. So as you can see, around all of the capital cities that actually matter, we're seeing massive price growth. There's been a little bit of lagging in some of the other cities, such as Perth. But what we have actually noticed in this market too is that houses are drastically outperforming units. Units are barely growing in comparison to houses. So obviously this makes sense because as people are in lockdown or they're wanting to have just a little bit more space. You don't want to be cooped up in like a 1 or 2 bedroom unit when, you could maybe move regionally, move a little bit further out of the city and have a much larger property, a bit more space, especially when you're spending so much time at home. And, this was one of the big considerations for myself when I was looking at our property. We weren't so fussed about living super close to the city. It's more about the space that we could get. So that was what we decided on. So we are seeing that as a trend that is continuing with all of these lockdowns, and people are just wanting more space, which makes perfect sense. So looking at the CoreLogic data, this is the important part. There's been a little bit of a change. There's been an inflection point. And this is really what we want to be looking for when we're looking into the housing market, is not so much the trends, but when the inflection points are. And what I mean by that is there's been a slowdown in growth. So what we saw around March was absolute peak growth. I believe in Sydney we had growth of over 3% in the month, which is insane. You extrapolate that out over a year and it's nuts. We're looking at like 36%, I believe. But what we've seen is the growth rate has actually slowed down. So while the growth is still really high, we've seen an inflection point where now the growth has started to slow. The rate of change has slowed down. So this is an important indicator for a number of reasons, and many economists believe that this is the point where growth will continue to slow down. And, we might see a little bit of growth through the rest of the year, but this is where the market might take a breather and might not be on the absolute tear that it's been on for a while, because at the moment there's not as many factors which are helping to drive that market higher. All of that sugar, as you would call it, those low interest rates, a ton of cash being thrown into the system, that has slowed down a little bit. Now, that's not to say that we're not going to see any growth, because I believe that this market is going to continue to be really strong for a number of years into the future. We might see a slowdown in growth, and we're just not going to see the craziness that we've seen over the last 18 months or so. Anyone that's bought in the last 18 months has probably done really well, but if you've been on the search for houses in basically any capital city, it's been really hard. Prices have just been going, and it's been really easy for prices to get away from people. I know anecdotally there's been some people in Brisbane that have been looking to purchase a property for them to live in, and they thought that $600,000 would be a really solid price, and they'd be able to get something really great near the city. But of course, over the last 18 months, it's just gotten away for them. And that same house, that they were paying $600,000 for, now is worth like $700,000, and it's kind of stretched them a little bit too far, and it's gotten out of their budget, their borrowing power, and their deposit. So it's something really worth noting. So I personally believe that this slowdown is likely due to affordability. Affordability is worsening. For a lot of younger people, it can be quite hard to get in the market, and that's just a fact. It's significantly harder for people in our generation to get into the market than it was for our parents and previous generations. You're looking at property prices that are like 7 to 8 times the average wage at this point, just for something average. And previous generations, that was more like 3 or 4, but it's just getting more and more extreme, especially if you're in the capital city. So I thought that was some interesting data to keep an eye out on. So you might see this market continue to slow in growth. It's not to say we're not going to continue to see gains. So in this instance, the best thing that you could probably do if you're looking to buy an investment property is looking for something that is going to be cash flowing. You want to be cash flow positive, because what's going to happen is as this continues to get more unaffordable for people, the market and all of the regulators, they're just going to start to put more restraints on borrowing power to cool it down. So what that means is it's likely that interest rates are going to go up. So you want to make sure that you have a property that is really positively cash flowing already, because the last thing you want to be doing is having a property that cash flows, and then they raise interest rates on you, and then all of a sudden you're just not making any return on that property outside of capital growth if you're getting that. But of course, interest rates have a really negative effect on the growth of property prices. So it's really something to keep in mind. So I hope you guys enjoyed this video. Please make sure you like and subscribe to this channel. It really helps to get these videos out to more people. My name is Seeney from Australian Wealth. Thank you so much for watching, and we'll see you later.